Acko is a digital insurance company with a license to underwrite and distribute bite sized insurance products. The company is essentially looking at decentralizing the insurance industry and is looking to establish a niche in India's insurance market by selling to customers directly through its online channels. In the latest dispatch of Meet the Unicorn, we speak with the digital insurer, which became a unicorn post its latest fundraise of $255 million dollars at a valuation of $1.1 billion dollars in a fundraising round led by marquee private equity firms, Multiples Private Equity, and General Atlantic. Canada Pension Plan Investment Board and Lightspeed Growth also took part in the fundraising along with existing investors in Tact Ventures. With someone in the business of underwriting risk of people at large, I begin the conversation by asking, how has the meaning of risk changed fundamentally for us? Varun, thank you for joining and talking to us. First question to you really is that the entire COVID-19 situation has really jolted all of us out of a black swan blindness. Before the COVID-19 happened, all of us used to behave that abnormalities don't occur. The risk trajectory in all business plans, in all AOP statements, was perhaps one straight line. All of us thought that the world is linear. But the COVID-19 situation happened and showed us that no, the meaning of risk has fundamentally changed. The meaning of how you factor in risks on how you're growing business has fundamentally changed. You have to now account for these kind of abnormalities. I want to understand from you, a company which really is a digital insurance company, how has the meaning of risk changed for you forever?
Thank you, Shrija, first for having me over. And I think it's a great starting question, especially for companies like us whose job is to underwrite risk. And when we are typically known as risk carriers. I think broadly, whether it's an individual today who probably was not aware that life is so fragile and maybe he needs far more financial protection or medical protection to be able to manage things, or it's companies like ours or so many others who've had to deal with this situation. I remember when the first time we heard of COVID and it broke out, and it was late February, early March last year, I told my team, yeah, I think we would need to shut down for 2 to 3 weeks, and yeah, we should be back in 2 to 3 weeks. That was my assessment. That yeah, this is something weird, but 2 to 3 weeks, let's just be a little conservative, and then we should be able to start it off. And now we're sitting at 2.5 years of working from home in some strange form. So yeah, things have completely changed. And I think a lot of businesses which haven't thought through, or one, it's a wake up call, I think, for a lot of businesses. Specifically to Acko, at least what it has taught us is two things: is when to go slow and when to hunker down, and when to put our heads down and when to go for growth.
Wow.
And what's the time where you should lean back and wait and watch, rather than trying to say, hey, I need month on month growth or quarter on quarter growth, and COVID's hit us, and how do we grow, and should we start any new verticals, what should we do, is
Mhm.
something else. I think Acko took a very different approach, and I think that's what we hold very highly in our organization, is that we will not go and do anything that we don't understand. So, for example, when COVID hit, a lot of insurance companies and the regulator and the government were keen that insurance companies sell COVID policies. In fact, few of our peers were the first ones to launch COVID policies, COVID specific policies. Uh, Acko took a call last year that we will not write COVID policies because we don't know how it's going to play out. We don't understand the nature of the risk. We don't know whether two people are going to get infected, 200, 2 million, or 20 million, right? And how many people will land in the hospital? How will the bills be settled? We don't know this risk. It's like saying, if I'm a lender, I am lending to anybody. I don't know how many people will pay or not pay back, right? So I think it was very critical and a good learning exercise, and a very as to how do you build resilience, how do you wait, how do you understand, how do you need to control your costs, not go for some certain segments of business, understand what's really important to you, and take a little bit of a hit if needed, but build for the long term. I think that wake up call, I think that was for Acko, for a lot of companies. And I think personally for me, it's been a exercise in restraint, if that's the word that I can use, because you panic, you can take wrong calls, but if you use restraint, We had very low growth last year. We've grown 3x this year. But that restraint period really helped us, where we put our heads down and said, let's understand what's going on, and not put our hands into things that we don't know how it will play out.
Thanks for that, Varun. That's really well said. I want to understand one thing from you, that you said that we refrained from COVID policies because that's a space you did not really understand. So, do you think, in the hindsight, that decision paid well for you, because the kind of catastrophic, sort of unprecedented kind of results that we saw, and perhaps in the hindsight, it was good that you did not take that decision?
We're very happy with that decision. I can give you a case in point. India's largest health insurance company, Star Health, which recently IPO'd, uh, I would they would have been hit by major losses of COVID, because anyways they were such large health insurers, so they had a very large size book. But yeah, one reason that they had such huge losses was COVID policies were written. They are at a size and scale where they can absorb it. They're a very large company, right? So they can absorb it and still do well. We had to understand our stage, our company, and where we stand. So we are very happy. We did not have any major debt. We had a little bit of a hit on the balance sheet, because we also underwrote health insurance, but nothing very big. And we've seen some companies really having 200, 300, 400% loss ratios for every 100 rupees of premium, paying 400 rupees of claim, and really trying to figure out where the capital is going to come from. We did not hit any of those issues. So we did not need capital. Even this new round that we've raised now, had not even come in when COVID had hit. So I think I'm pretty happy with the call that we took. That we did not underwrite a risk we didn't understand. For most people, it did not play out the way they thought it would play out. It played out much worse. Everybody was happy in the first wave. We wrote COVID policies and nothing happened, and then the second wave, it all came crumbling down. So
Yeah.
yeah, in hindsight, I think we took the right call.
So it's kind of blew it on their faces to do that. I think it's a great message for entrepreneurs coming here, that how do you balance short term profit maximization over long term growth, and burning your fingers on doing things which you don't necessarily understand clearly. And especially for someone like you who's in the business of underwriting risk, some of these opportunities could be very tempting, to say the least.
Yeah, very tempting, because there's no growth. Our business had fallen to less than half in the first wave. So whatever trajectory we were in, we were doing 60-70% lower business. So you have 100% of the cost and 30% of the business. So that's a pretty scary. I would still count ourselves lucky that we were not in a category like entertainment or travel, which had gone to zero, and we were still at 30-40% or whatever it was. But yeah, the temptation is strong. The teams are panicking. Everyone's saying, hey, can we do a little bit of this? We have partnerships, large partnerships with a lot of digital players, about 20, 30 of them. They wanted to sell COVID policies. We were already integrated with them. They asked us for a product. Hey, you're a partner, give us a product. This is a product that's really selling. Customers wanted. We had to sit our partners down, who we have great relationships, and say, hey, we cannot fulfill this demand. If you want to work with somebody else, please go ahead. But we would request you that this could be reputational damage for you too, because we just don't know how these claims are going to get settled or how it's going to happen. So yeah, very tough conversations, with partners, with our own teams, saying, hey, everyone's doing it, but let's just hold on. We don't know what's going to happen, and we'll take that hit for 3-4 months, where we'll continue at 30%, 40% revenue. Yeah, so very tough conversations, panic time. But I think we resisted the temptation, thankfully. So yeah.
Yeah. So if I were to ask you, Varun, that what were the vulnerabilities for the insurance sector which got really exposed the past 2 years in the aftermath of COVID? What would those really be? What were the lessons which sort of came very hard to learn by?
I think just lots of things just went, so there were businesses. So insurance, we tend to have a very generalized view that insurance, it's either it's risky, or insurance is a push product, or all of these pieces. But actually, every category in insurance works very differently. So auto insurance is, in my opinion, never a push product. It's a pull product, because you have a deadline, you have to buy it. People understand the product. It's compliance driven. Health insurance is a little bit of education, a little bit of push. So all of these products work very differently. During COVID, It was very strange. Nobody was buying car insurance for 3 4 months because people were not taking the car out in the lockdown. So I can procrastinate an expense. And the government had also come up with regulations that insurers need to continue to extend people's policies. So nobody is buying, they're not going out. So there's no growth, but there's a lot of profit because nobody's using the car, so there are no accidents. So no growth, but high profit. So we didn't get any claims for 2 months. Imagine an insurance company not getting any claims for 2 months. We tried to refund actually customers money that you're not driving your car for 2 months. You take your 2 months premium back. So some of the customers actually claimed that refund because you're not using the car. On the other hand, when you look at health insurance, there was high demand, very very high demand, and very high losses. Uh, so, uh, so I think each of these categories has worked out very differently. But at an an overwhelming level, I think what's really happened is that it really has pushed, let me not call it digital, but digitization of processes and workflows and attending to customers at the fore. Because the first 30, 40 days of lockdown, and when claims started coming in the initial phase, companies, we were lucky because we started out as a tech first company. There were some tech folks in our office who would anyways work from home once in a while. So we were not very affected because we were just wired that way from day one. And I don't think it was by design, it was lucky, right? We were born in a generation where everything's done this way, right? So but we saw for a lot of the older legacy players, the teams which fulfill claims used to work on VPN connections on desktops in office. They went home and there was no way to even access a customer claim, and they took 30 40 days to actually unlock those VPNs, put in new security, allow people to work from home, so that I could fulfill your claim as a customer. Paper had to be driven out, signature processes had to be done away with. I think it was a big wake up call to say, hey, this digitization is not just a theme in the boardroom. We
Yeah,
really need to do it
secular
across the
trend.
business. Yeah,
It really emerged a secular trend and got into its own. I remember
yeah.
having a conversation with the VC, and he said that the 5 year digitization, Shrija, we've added in 6 months, and that really is that means renaissance for VC investors. And what kind of canvas to play with, where every industry really got into its future. It was essentially accelerated by 2 or 3 years. Arun, I want to ask you this question. For an insurance industry, you really are at the business of underwriting risk. That is really at the core of what you do. When an opportunity like this presents itself, COVID-19 situation, as a businessman, perhaps you are taking that decision of not venturing into something which you don't necessarily understand. But from what you're supposed to do, don't you think that you are perhaps not giving your end consumer what he or she needs at perhaps the most difficult phase of his or her life?
Sure, that's a good moral question. I think there were better ways to do it, and we would have participated. And this is my view, personal view, in that zone. So a catastrophe and a tragedy like COVID is not manageable or handleable by 10 or 15 private enterprise companies like insurance companies. The number of people who actually bought COVID policies in the last 18 months or whatever it is probably still not even 2% of India's population. So it's not like just because we sold insurance policies, we are helping the consumer in a meaningful way. Those policies were sold; they had certain restrictions. People didn't get half their bills. Everything was getting overcharged by 3x. Insurance companies were eventually paying one third the amount that this is overcharged. So in my world, in my head, it was profiteering, or it was very opportunistic for the industry to do it in because there was genuinely, you were not being able to. Yes, some people benefited. I'm not saying zero people benefited. The right way to would to for the industry to have participated would have been to keep a standard price, which would have been decided by the government or the regulator, and said that every insurance company will offer at 5,000 rupees per annum COVID cover. I think we would have played a beautiful, role in doing that. What
Distributing
instead
it on a mass scale. Yeah.
distributing it at a mass scale. What really
Hmm.
happened is that the government asked, or the regulator asked, that you price the product on your own, and it
They became
became a
very
game
optimistic.
game
Yeah.
theory. It became game theory. So actually, the guy who priced the lowest, the insurance company who decided to price the product the lowest, was getting all the risk.
All this. Yeah.
They will get
Yeah.
all because of COVID product. So each insurance company was actually, you won't believe this, was trying to see what is the other guy's price, and let me charge it a
Or
little
more
higher,
than
so
that.
that higher,
Yeah.
so that I don't
Higher.
get all of the bad, very
Yeah.
somebody who has been exposed to COVID. Let's say somebody in my family has been exposed. I will certainly want that insurance. And what will I do? The product is the same, so I'll go and buy the cheapest thing available. So
The
everybody
consumer
was
is nowhere in the picture. The consumer
nowhere.
experience is nowhere in the picture.
Nowhere
Yeah.
in the picture. Insurance companies trying to game each other, saying मेरा price ये है तो ऊपर कर लेते हैं थोड़ा. Then the bills come. Bills are not verified, very unclear. Half the money is paid, half the money is not paid. So I think it wasn't done. It could have been done better. I also would not like to blame the government or the regulator, because I don't think they've handled this, or anybody in their lifetimes is
Yeah.
handled it. Maybe, hopefully, it doesn't happen the next time. But if there is something similar, even locally, that happens, I think there's far more maturity in the ecosystem as to how to deal with it. So if it was done in a way where there was mass distribution of a standard product, like third-party insurance for cars, right? The price is fixed. You're supposed to distribute it. I think it would have worked well.
So, what makes a resilient insurance company? What makes an insurance company resilient? What really is a recipe for that?
See, from I think one of my very clear aspirational, pieces that I've looked at globally is a company called Geico, which is Warren Buffett's company, and that's really been, at least philosophically, not the model, but philosophically, our role model, right, in some sense. And one of the things that, if you look at the entire insurance industry in India, barring one or two companies, nobody makes an underwriting profit, which is the claims cost plus the commissions that they pay to source the business, and their operating overheads, which is the salaries and the branches and all of that. If they collect 100 rupees of premium, the claims plus the commission plus their operating costs are all over 100 for 98% of the companies. I think out of 25 general insurance companies, 23 are in this zone, where they collect lesser money than they actually spend. But these companies are still profitable, because insurance companies have two income streams. One is premium, and float money, the investment income that they earn out of the premiums that are collected. So basically, you're making money not from the insurance part, because that insurance is negative, and you're making money from the investment income. From an Acko perspective, what makes us resilient is that we're very, very clear that which segments we want to underwrite, and we will always go for underwriting profitability. And the reason why we will do that, and we should, or any insurance company, I think, in the world should do that, is otherwise your profits, your top line or bottom line, everything's dependent on how much investment income you can make, which is subject to markets. What are the interest rates? What can I get? You're not doing anything to actually maximize that income. It's really depend on macroeconomic factors. And in India, as the yield starts getting low, as interest rates keep coming down, now we are all getting home loans at 6%, 6.5%. So insurance companies are also not making that much money on the investment income. So underwriting profit is not something that people have focused on, and that is what I think makes a resilient company. And I don't think that if everybody runs the same model of outbidding each other with brokers and agents and car dealers saying, I'll pay you 25, I'll pay you 28, sell my product, how you're going to ever get there. So what makes it resilient is very, very clear that what risk you need to underwrite, what you need to stay away from, and how do you build a model in which you can land an underwriting profit in the long run.
I think I will also get on to how you built your business. And it's an interesting one. You raised a huge round of seed funding. It was kind of, the ticket size was, I would say, a typical Series B size, which you got for seed funding. And of course, at a time when capital is super abundant, one can really argue what check sizes VCs are after. But the question really is that, do you think that insurance and fintech, the large industry that you are into, by virtue of the industry, you require that much capital to start a business? Or was it a case of You just wanted those many people on your cap table and those names on your cap
Not
table.
at all. I think it was a necessity. I don't think the regulator demand. If you have to set up an insurance company in India, the regulator will not allow you to set up an insurance company in India unless you have maybe close to 300 crores of capital. That's the regulator's demand. If you go to the regulator in India and you come up with capital less than 300-400 crores, they will not even give you a license. So for us, it was important to be able to display that we have adequate capital to start an insurance company. So if you would have raised 10 million and gone to IRDA and said, give us a license, they would have said no. It was a necessity of the kind of business that we wanted to run. Wasn't that we were trying to raise one of the largest seed rounds. That wasn't the case. It was the licensing has some requirement.
Regulatory. It was a
The
regulatory
license,
requirement.
yeah,
Yeah.
regulatory. Yeah.
But Varun, so why did you choose insurance as a space to get into? Why was it that you wanted to deal with an institution like IRDA? And it's a complex business at the end of the day. You're dealing with human lives, you're dealing with risk. Of course, you're in general insurance, but why insurance? I wanted to understand.
So I don't think I chose insurance necessarily. I think it chose me. It was the other way around. I didn't get up saying I want to solve this. This is a big sector, high growth rate, and tech can play a difference. My first job was in insurance. So I spent 5-7 years doing that job. Then I had a little bit of mutual fund business experience. Then I set up a small company which was making software for insurance companies. Then I set up a broking company. So for me, it's just been one journey. Even before the word fintech and insurtech were coined, I've been in this business. So for the last 15 odd years, sometimes as an employee, sometimes as a software services provider, a broker, and now a manufacturer of insurance. So for me, it was always when I was employed, I would like, hey, we could do this better. Why aren't we doing it? And I said, "Arey, inko technology nahi chamak raha hai. These guys don't understand technology. So I'll set up a software company which will give the technology." So I set up a software company which is focused on giving technology or providing technology to insurance companies. Then say this is not working. I think I need to sell the product. That's when CoverFox happened. I set it up. No, I want to sell the product.
Yeah.
And 18-20 months into setting up CoverFox, I was very clear that no, this is not going to solve it. Until we control the product, price, claims, experience, everything, I don't think we can deliver the value that we need. So for me, it's just one
One value chain, from
one value
software
chain.
to products to sort of getting into the entire enterprise. So that really sort of you got into your own, essentially understanding the insurance industry, starting
Yes.
from technology side to become the manufacturer of products, and then controlling the pipe as well as the products that go into the pipe. I
Yes.
want to understand from you, Varun, one more important thing is that's the question I have for fintech entrepreneurs also. Banking in India has been plagued with NPAs, and you understand that. And one of the biggest risks really has been the entire failure of the banking incumbents to perhaps underwrite risk in the manner that they should have done. When we've not done such a bad job compared to our Western counterparts. Uh, what is it to say that a digital fintech institution, which is so nimble, would do a job the traditional bank, which has such legacy, better? The same question I have for you. What is it which you think that traditional insurance companies have failed, which someone like you can easily solve for?
So I think I think it's a matter of, so whether it's insurance or lending, I think it's a matter. These are very vast sectors, and they need expertise. Expertise in segments. You can't be everything to everyone. So if you look at HDFC, and which is always sustainably had very low NPAs, and they focused on retail, right? They were never big into infrastructure lending and so on. They built an expertise, and they stuck to it. Likewise, we've seen ICICI, bunch of these times, or bunch of others who've had these cycles, right? Or some large NPAs, corporate loan books didn't work out, and so on and so forth. I don't think it's any different in insurance. It's the same thing. What risk you want to underwrite, at what scale you want to do, which segment you want to build your expertise on, how do you get better with data and with underwriting, and focusing on the risk of that segment and continuing to improve, rather than saying everything is I will underwrite everything, which is where the industry is today. A large part of most of the traditional guys today, or the larger guys today, they write everything, right? They do auto insurance, they do health insurance, they do crop crop insurance, they do aviation, they do fire, they do marine. So you are doing the same corporate lending book. If I were to juxtapose you as to a bank, you're doing corporate risk, you're doing retail risk, you're doing everything. And today, Acko is the only one which does only retail. We don't touch anything commercial. We don't do, including some of the newer guys that have come in, Digit, all of them write commercial. So to me, I'm not saying commercial is a bad business, but then you do it and you do it well, and you develop very very high expertise in it. I don't think every company can do everything very very well. That just doesn't happen. So we've chosen our segment well. We continue to build our capabilities and expertise in auto and health. We are very clear who our customer is. We don't change our customer. The government is a customer when you do crop insurance. Airlines is a customer when you're doing aviation. Then you and me are a customer for auto insurance or health insurance. If everybody is your customer, then you cannot build intelligence on everything and expertise on everything, right? So
It's about
for us,
choosing your spots and building specializations in that.
building specialization, and we've seen you see health insurance, Star Health, Aditya Birla, Care now, Religare, which is, these guys are focused on health insurance. That's why they're doing so well. All of them are doing well because they're very focused on solving one of the
Rather than
things.
having a very factory kind of approach to be doing everything for everybody. Yeah.
Yeah, it's also risk profile changes, right? If
Yeah.
you're writing aviation and crop and all of this, one bad year you'll have very high losses. It's like your corporate lending book, right? So I always we maintain this with our board and with our team, that if you're in a financial services balance sheet business, whether it's an insurance company or a bank, if you're looking at top line numbers, you are bound to fail. You have to look at risk adjusted growth, not at growth as just the top line, number. It's very easy to, if you want to lend, I can keep lending. If I want to write insurance at low prices for airlines and crops, and I can keep doing it. It's very easy to scale. Tomorrow, if you ask me, hey Varun, you're my board member, and you ask me double your top line, yeah, it's very easy. But
Yeah.
what are the losses sitting on it? Nobody knows.
So, what really, let's talk about your numbers a little. And I think you have a different approach compared to some other fintech entrepreneurs that I speak with, where perhaps the entire pursuit is to become that large digital bank and just get those numbers. And in fact, I don't want to name an entrepreneur, but I was there with him on the show, and he was pretty blatant about it. That for me, it's about expanding the funnel as much as I want. I can become profitable from today, but I want to. It's about the ambition, how large a company I want to be. I want to understand from you then a bit of numbers, Varun. What are your revenues like? And are you profitable? And what is your burn rate?
No, we're not profitable. We're still like, even any insurance company takes 7-8 years to break even. Typically, we are about, now this will be our fourth full financial. Next year will be our fifth full financial. This year we will have about 1,000 crores in revenue. 1,000 to 1,200 crores is where we're likely to land March of 22. And next year, hopefully, we should be able to double that. In terms of burn rate, I don't think our burn is very high. We must be burning about 30 million a year, maybe. That should be our burn rate. So we're sufficiently well capitalized. And to at a macro level, to answer your question, I don't think you can build. This is my personal view, and I'm hope we are right, and some of the other people are not so right. Let me not say wrong. Is that I don't think you can build a business saying I have lots of customers, I have a huge funnel, and I'll make it work. Paytm is a case in point, right? Like, it's not working at the pace that we would like it to see. I would like Paytm to see do much better,
I
because
agree. I completely
it
agree.
impacts our valuations, the confidence of the
Absolutely.
public
Yes, it
on
does
new
in
age
a big way.
companies, in a big way. So we would love to see them do well, but at least what's visible is that you can't have a very large funnel base. Very large funnel doesn't mean profitability and high revenues, right? It's still hard work after that. So at least Acko's thesis is that it's not to say that we're less ambitious. Would we like to be a bank someday, Acko Bank? Yeah, why not? Would love to be. But I
Wow,
think
you
if you
just said that. That's a revelation coming. The pursuit of
no,
ambition
that's
never dies.
no, it's aspirational. I don't think we have a plan. I don't think we are even doing anything to get there. But is it possible? Would we like it? Just as crystal ball gazing or dreaming. I'm not even saying it's a plan. Yeah, we would like it. Why wouldn't we like it? But the issue is that if we don't do the first part well, we don't build a good brand, we don't show revenues and profitability on the first thing that we picked up, uh, it gets very hard to say that we'll make everything work. But if we make one thing work, investors trust you, customers trust you, then you can keep expanding. I don't see a problem. But you have to look at it like a 10-year journey, or a 15-year journey. If you try to do it in 3 years, you can succeed, but it's very tough. I would say it's super tough to get 5 categories working in 4 years, and
So,
raise a
what
lot of
really
capital.
are the points of confrontation with the investor in the boardroom? I'm sure your burn is essentially a board sanctioned burn strategy, burn number, not necessarily very high, $30 million annually. Uh, if I compare to e-commerce, definitely these numbers look minuscule compared to
I
that.
get scared by those numbers. So.
Yeah. So what are the points of this constant slugfest between the investor and the entrepreneur? Because there is always in every boardroom. What would those really are for you?
Uh, I'm not exaggerating when I say that we've been lucky and we do not have any such issues. And I don't mean to say it just to sound nice or make Acko sound nice in any way. Touchwood, we've also chosen our investors well, and I hope they have chosen the right company too. Which is, if you look at our cap table, when we were at the early stage, we had guys like Axel, Saif, most reputed guys. In our growth stage, we have chosen to go with the likes of General Atlantic, Canada Pension, and all these guys. These are very, very institutionalized investors who have run banks, who have run insurance companies, who have. So Canada Pension is an investor in Kotak, for example, right? Like in, so say they know how to build financial services businesses. They are not the, hey, we'll give you a valuation, because it's a heated market,
I must say
in
your cap table is very impressive, especially the fact that you got CPPIB on board. They're very long term and which you're seeking
very long
investors.
term, very
Yeah.
long term. So we've got guys like Amazon who think very long term, think customer value. Amazon, General Atlantic, Canada Pension, Multiples, which is a traditional private equity firm rooted in India, very, very conscious on
Yes.
finding right value businesses. So I don't think we have on our cap table, what I would not like to name, but what I'd like to say, momentum investors.
I like the way you
There,
think. Yeah.
so we don't have any momentum investors. We have very high quality investors who think about the long term. So I think they have onboarded to our plan. They don't compare our numbers to company A or company B. They know what model they bought into, our model and our thesis. We have a certain internal growth rate target, certain metrics, how we want to build the business, how we want to build the brand. And fortunately, these are not winner takes all market. It's not a Flipkart versus Amazon, or an
Hmm.
Uber versus Ola. Our category is 20 players can build $20 billion companies. There's no
So
problem.
when you say it's not a winner takes all market, it's like as is it like edtech? If I look at edtech, for instance, there's Byju's, and the number two is perhaps is a distant number two, right? I mean, the if you look at the numbers or the valuation, so how will it play out in the insurtech market? If you were to give me perhaps an analogy for that, because what I'm understanding from you that you want to be a specialist insurance player. You have chosen your sweet spots, and you want to be perhaps the go-to for those sweet spots. That is what you're looking at, right?
Yeah, so if you look at it, and so first of all, I don't think there's any specific insured tech market. I would like to call it the insurance market. ICICI is investing in digital, Digit is investing. Everybody is competing for the same customer, offline, online, doesn't matter. You're competing for the same. Are you able to provide better value, build a better brand, build a better experience, and do it profitably, or more smartly, is really the goal. So if you look at insurance as a market, even take ICICI Lombard, really great company, been around for 20 years. It's still got sub 10% market share. It's the largest insurance. I'm talking insurance market share. You take the US market, the top three insurers put together would probably have 30%, 40% market share, top three, four. So this is not when we talk about ICICI Bank and HDFC Bank, we rarely talk about how much market share ICICI Bank has, HDFC Bank has, or Kotak Bank has, right? We don't talk that language. It's the same for insurance. So I think
The opportunity is
there
just
can
so untapped. It's just so huge, the
it's
opportunity.
huge. It's huge. And I think there can be at least 10 insurance companies in India, general insurance companies, worth more than $10 billion. 10 or 15 is what I would say.
Yeah, I think we're
Yeah.
getting towards the end of the conversation. Very, very interesting conversation by far, Varun. So we spoke about the opportunity. We spoke about how you are building out. You spoke about the resilience. You spoke about the fact that how one has to be extremely careful and what opportunities to go after and what not to go after. Not going to things which you don't necessarily understand. Important nuggets of wisdom coming out. But what should be the key challenges if what you are facing while building your business? What would those really be? If you were to go back in time and just to rebuild Acko, well, what would those really be? Every entrepreneur has that when you talk to yourself, when you think it for yourself. So what would those really be?
Yeah, I think one of the largest challenges that we faced and continue to face, but it's better now, is the fact that when we talk about digital insurance, or digitization or insurtech or all of these pieces, there's a very big difference between having digital processes versus running a tech based model. We sell directly to consumers. We don't have a single broker. We don't work with agents, brokers, so on and so forth. Not that that's a bad thing, because we think we can pass more value to customers by going direct or having technology enabled partnerships rather than having physical partnerships, because that saves cost. You own the customer, the relationship with the customer, and your business economics improve. For that, you need to be able to build technology the way a Flipkart would have built it in a sector like insurance, right? Or the way Amazon would have built it. Maybe they're at a much higher bar in terms of quality and scale, but you need to have the DNA in your company. But when you try to have that DNA in your company, this is also not a business in which you don't need domain expertise. You need people who understand health claims, who understand third party pricing, actuarial, reserving, balance sheet, regulatory management. You need these people. And one of the challenges in the insurance industry has been that these two worlds of techies who work for the likes of Google and Flipkart and Amazon, and these guys who work for the traditional banking insurance they don't talk. That's a Bombay industry. This is a
That's a
Bangalore
Bangalore
industry.
industry. Yeah.
Yeah, so they're very chalk and cheese, right? And they don't talk to each other at all. They don't understand each other's language. The way of approaching a problem, the way of actually thinking through something is very different.
It's where
Uh,
the heart
we,
is. Bringing both of
yeah,
them together.
we're a 600 people organization now, out of which 300 people are tech, product, data science. The guys who like would be working at a Swiggy or a Zomato or so we have the same bunch of engineers, and we compete for that same talent. And so I think the biggest challenge over the last 4 5 years has been bringing these two cultures together, for me. Because I understand, coincidentally, I've had the opportunity to work on both sides. So I understand, I've been blessed. I would say that I understand both sides, and that's where. But getting these two sides to see each other's point of view, and that's what I tell the team, that if we can collaborate and bring this world together, that's the recipe for
Magic.
success. Because that's magic. That is the magic that we're trying to achieve. So hey, stop fighting. Hey, this guy's not understanding this, and this guy's not understanding that. I think where
Yeah.
we've reached is a beautiful place. I think a great place where these guys, the guys who understand the domain, now really appreciate the value that the technology guys bring, and the technology guys equally respect what expertise these guys are bringing in, and they collaborate. And that's for magic for me to see. But it's been a challenge to get these words
Yeah.
to talk. Yeah,
I can totally imagine. These are very different orientation. The mind works very different in those two spaces, the
absolutely.
tech and the banking expertise. But tell me one thing when I were to ask you a question, that when I speak to entrepreneurs, it ultimately boils down to the three things. That Shrija, our technology is great. We keep customer at the center. We have democratized this space. We have no brokerage, everything. So all of you sort of sound to me very similar from a distance,
Sure.
and ultimately all backed by marquee names in your own spaces. There are funds like the companies like No Broker, for instance, they raise money from Ribbit Capital. Everybody has their own sort of prestigious investors on their cap table. I want to understand from you that is the moat important for similar looking companies, or just the sheer market is so huge that there's room for everybody, plus there's a benign supply of capital which helps to get going.
So I think capital does two wonderful things. One is that it'll propel good companies. It'll also create some excesses, or it'll also create some things which should not have been done. But it also genuinely helps the companies who are building it the right way. Abundant. capital helps the companies that are building it the right way. So it's always like there will be collateral damage, and we have to accept it. That some capital will go to waste, some models may not work out, and that's how the world works, frankly. There will be some collateral damage. What I, however, believe in very, very strongly is that the way businesses were done 20 years ago, or in the last 20 years, the next 20 years will look very, very different, right? And some of us will figure it out, some of us won't. But what will definitely happen is wherever there
But
is fat profit.
how will that look like the next 20 years? Is it
I, I,
metaverse you're talking about?
no, I'm not talking about all of that. That's too advanced for me. I don't get that world. Maybe those should be much younger entrepreneurs than I am who can figure that out. I don't get it. I don't understand crypto, blockchain. I have very little idea of it. But I think next 20 years, what I mean is wherever there are legacy industries, whether it's insurance, whether it's banking, whether it's commerce, or any of these pieces where there is inefficiency and fat margins sitting, technology will erode that, right? Like today we're getting to a fairly significant size on auto insurance, not a single broker, agent, or dealer. This has happened because we reduced that cost and went direct to customers. So that democratization makes sometimes just becomes a wrapper for startups who may not be delivering that much value. I hope most of them are, and for some somewhere it's really genuine. I feel, in where you're democratizing that value. To give you a sense, where the industry today pays 25 to 30% commission on your car insurance every year, which is a mandatory product by law that you're supposed to buy if you own a vehicle. It's completely unnecessary. Like, I don't see I can understand if you need advice on a product like life insurance. What advice do you need? There's no advice. It's a compulsory
What
product you have
advice
to buy.
from? Yeah.
Yeah. These are fat value chains. These are inefficiencies. These will go away. Technology will make sure that these unnecessary inefficiencies will go away, and people will build businesses out of it. So I think the next 20 years, when you use the word democratization, some of it may work, some of it is I think nice things to say, but I think you'll see more successes than failures of some of these models. But somebody has to take that call and test it out. I think few will fall by the wayside and fail. But that's how innovation always happens, right? Few people will get it, and few people will fall by.
The most loosely bandied word around democratization. That's why when VCs have started to complain, please don't send a startup pitch with the word democratization there. So, what really is the end game then, Varun, if at all you think it's too premature to ask? Will an LIC buy you out? I mean, how does it work then here? If
I
I
don't think
look at the no,
LIC
if I
would
look
identify as well. Yeah,
if
I
I look
hope
at
not.
if I look at the fintech industry, there's the traditional bank having a very frenemy relationship with the fintech. You need it, but you also hate it. So there are partnerships. They've learned to coexist. How will this evolve in the so-called insurance industry? Will there be a Bajaj alliance which will learn to live with a Digit, or which will learn to live with an Acko? How will these partnerships work? Or is it an IPO route for you? What really are you eyeing?
Yeah, I don't think it's consolidation is the route for us very, very clearly. I think we've if to be honest, if I take my entrepreneur hat and my love for my own company out and remove that bias, and if I take a banker's hat, or a or a hat of a M&A guy, or something, if somebody has to buy Acko to say, hey, this is a new age technology model, it can add value in the future, it should have been 2 years ago, where we had limited capital, we were still figuring out the model, and so on and so forth. I think touchwood, we've crossed that stage, whether it's capital or revenue size or scale. And we are also not in the neobank kind of world where I'm operating on somebody else's license. I have my own license. I have no challenges. I don't need a bank's license to operate, or I don't need a LIC's license to operate. I have my own license. I have the same license an ICICI Lombard or a Bajaj Allianz has. So we sit in a place where I don't need that partnership. I think some of those companies have done great work, but yeah, I think we would be at in our heads at least, unless we execute really badly for some strange reason, we would love to go for the IPO route, because I think we're reaching that size and scale. I think in the next 2 years we could be in a position where 1,000 crore revenue would easily be about three and a half thousand crores, because I think one thing is critical to understand is we are a compounding revenue business. whoever buys from me this year comes and renews next year. So the renewal just keeps, the business keeps compounding. And because we don't work with agents and brokers too much, our customers remain persistent with us. Agents and brokers ही है ना, आज ICICI का ले लो, कल बजाज का ले लो, वही घुमाते रहते हैं. So when you deal directly with customers and they like the platform, they mostly come and renew. So the revenues keep compounding. I think at that size and scale, I think we are definitely an IPO candidate, and we'd love to be a public company. Also, because when it comes to financial services, whether it's regulators, whether it's investors or customers, listed financial services company just carries much higher level of governance and trust in the entire ecosystem. So one of the other reasons, apart from an ambition of being a public company, is the fact that it'll help our business, because the regulators respect you a lot more, investors respect you a lot more, your governance standards are much higher. So I think that would be the route for us.
So you are 1,000 crores now.
Yeah.
Okay. And if you're eyeing a public outing, that means you need to show profitability. You need to show growth which is predictable,
Doesn't
which
look
is
like
steady.
with the doesn't look like with the last few IPOs. Yeah, but I would agree. We would want to get there. I think we need 2 years to get there, where we are close to profitability. We have huge scale, and we're very patient. We're not. I think one of the things you'll hopefully over a course of time learn about Acko is that we're a super patient team. We're not in a rush to win tomorrow. So I think we have another 2 years, we believe, is the right time for the company to be mature, to be able to handle quarterly public scrutiny, to be able to have the right team to be able to manage a quarterly public scrutiny. Our business needs to get there. So if we get it in 2 years, I'll be happy. If it takes a year longer, I'm okay. Yeah.
Doing an IPO is not necessarily a big task anymore, but the fact that you earn respect to go through that public scrutiny will be tremendous when you go public outing, and that is where what will distinguish you compared to the other names or peers that have already had. And that will what will make you truly anti-fragile. So I would suggest build a business which is steady, predictable, and one which can really stand the test of public
Absolutely.
shareholders. Lovely conversation. I think it is time to ask you the last question. This
Okay.
entire narrative on ESG, do you think it's really a fad or a greenwashing happening? Some of those components are also coming in the finance industry in terms of underwriting risk for ESG. Uh, do you think that the noise is really in the right direction? Or again, we are seeing a round of greenwashing happening? What really is your sense? For someone like you, it becomes important to ask this because you're building a large insurance company.
So I'm not an expert on the topic. I'm exposed to it, but at least what I think is that it is going to become critical, more and more critical over a period of time. Just recently, I was reading yesterday that Tim Cook from Apple, his a big part of his stock grants are now linked to meeting ESG goals, not just the revenue goals or so. So I'm assuming it's getting more and more important from what I understand. I think for an insurance company like us, for our own operations, I think it's important, but so. For example, we don't run any factories, we don't have any carbon footprint. We are a services business, right? Like we sell a PDF and we settle claims, right? So we don't have any of those pieces. So I
You're
don't think there are
sustainable that way automatically. Yeah.
we are automatically sustainable. Yeah, I think it comes to if you're writing commercial insurance and you're writing a polluting factory, and you're underwriting their risk, so should they be charged higher because they're creating pollution or whatever it is, or should it be a different rating factor for pricing their insurance and so on and so forth? Maybe those areas it will come up, but like I said, we don't write commercials, so even that area I don't know how much it'll impact us. Yeah, what I do understand is it's becoming a part of every conversation. It's becoming a part of our commitment to our shareholders in all our documentation. So we have set up units for the kind of business that we run. I don't think it's very heavy because we're largely a services organization.
It's time for rapid fire now. So Varun, what really is the future of insurance industry? One line.
Acko.
Okay. What according to you is the most overhyped unicorn according to you?
Oh, I have to take names, is it? Uh,
Yeah.
My friends, yeah, don't do this. With all due respect to all of it, I think I would say Oyo in my head. Yeah.
The most overhyped public outing, according to you, of a tech company in the recent past, what would that be?
Paytm, any day, any day. I
What-
I think I think they could have, I root for them, by the way. I'm not saying this in a bad way. It's really important for my own valuation and the entire ecosystem valuation. So I'm hoping the price goes up. So, but yeah, I think that didn't turn out as well. We would have all liked it to.
Okay, one message for Digit, what would that be?
Keep doing what you're doing, because then there's nobody doing what Acko is doing.
You really are coming across being somebody who is so self-aware. I must say this, you're very self-aware.
Is it? Okay. I
Yeah.
don't know. Yeah.
Okay. And my last question to you is that what would be your advice to VCs in terms of the VC bubble building out? How does one retain sanity during these times? What would be your advice to them?
So I used to, so my perspective has changed from being more sane on this to saying, hey, a lot of the older, guys from Axel, Seth, a bunch of the other VC that I've interacted, they're all friends now. So earlier when I thought that they funded a company which I thought was not making sense, I was like, "Arey, ye kya kar rahe ho?" Like, just casual conversations. But I'm sure they had their thesis. They're much smarter investors. I've never run a fund, so I don't know. But I think over a period of time, what I've realized is it's a probability game, and sometimes you have to take gut calls, and some of them will turn out really bad. But that's okay. They need 20-30% of their portfolio to work, and nobody knows the future. Just absolutely anybody who says they know what's the right thing to do. Everybody beyond a point is doing their analysis, and I believe eventually taking a gut call. And when you're taking those gut calls, you will be wrong in some places, and you have to compete. Like you rightly said in the beginning, capital is a commodity. So if there are two young kids who come out of Stanford and now delivering groceries in 2 minutes, you will have
I
to
know.
look. You will have to look at it. You
Seriously.
can't say no, no, this is not going to work, because you don't know. Maybe it just works. And so you can't turn your eye away and say, hey, I know better, I'm in the value investing world. I think the times are changing so quickly that nobody knows. So everybody will make some bets which may not sound very sane sometimes, but that's okay. But that's how innovation will come up, right?
Thanks for that, Varun. I thoroughly enjoyed our conversation, seriously.
Same here,
Until
same
we
here.
see you next, goodbye and good luck. Thank you so
Yeah,
much.
thanks
Thanks for
so
your
much.
patience. Bye bye.